Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Brandon Rakszawski, product manager at VanEck. In today's podcast, we talk about the concept of wide moat companies, some key areas of competitive advantage, and how this approach can help in the investing world. So make sure to stay tuned for that right after this. Brandon, thanks for joining us.
Eric, thanks for having me.
Yeah, so maybe first off, we can start by talking about what is a wide moat company?
Yeah, certainly. So Morningstar, who is the index provider for VanEck's Morningstar Wide Moat ETF, defines a economic moat as a company that possesses a sustainable competitive advantage. So Morningstar equity research analysts will review their entire covered universe of stocks and their underlying companies and determine whether or not those companies possess one or more competitive advantage, and they will assign an economic moat rating to that company. The moat rating can be a wide moat, narrow moat, or no moat, and those ratings essentially indicate whether or not the company has a competitive advantage, and then how long Morningstar believes that company can sustain the competitive advantage. So a wide moat rating, which is the most exclusive moat rating assigned by Morningstar Equity Research, indicates Morningstar's belief that that company can sustain its competitive advantage or advantages for at least 20 years into the future.
So why is this something investors might want to focus on?
Well, it really goes back to the concept of investing in quality companies that are well-positioned in their respective marketplace, that can fend off competition through various market cycles. And that really speaks to the core of Morningstar's equity research process, is really identifying companies that are well-positioned and have built up that defense mechanism that they can sustain competitive pressure into the future.
So maybe you could give us a couple examples of some of these competitive advantages or how a company might get a wide moat. Is it something about brand name recognition, or are there other examples you have?
Yeah, definitely. So Morningstar has identified their 5 sources of competitive advantage, and I can walk through each of those 5 fairly quickly.
Yeah, sure.
The first of which is intangible assets, what you just mentioned, brands. So this is the concept of a company such as Tiffany's or Hermes that has such a brand associated with its product that it can charge a premium for what it's providing in the marketplace. Another source of moat would be switching costs. This being the concept that a company can become so ingrained and built into the workflow and the process of another business that the other business may have reservations about moving away from a particular company's products or services.
Or like maybe for a bank, if it's just too much of a pain for us to switch over to a new operator or something like that. Is that a decent example as well?
That's a great example, and a lot of retail banks do have wide moats, and switching costs are definitely one of those sources that are identified. So switching costs is very common for those companies that have, positioned themselves well in the marketplace, and it's difficult for either a retail consumer or a large business to move away from those goods or services. The third source of competitive advantage is the network effect, according to Morningstar, and this is the concept that the more users of a product or service, the more valuable it can become. And a great example of this, and one that's at the top of most people's minds, is Facebook. So the more users on Facebook, the more incentive for others to join that particular network. And credit cards can be another good example of this. The more users that have a Visa card or an American Express card, and the more retailers that will be incentivized to accept it, and it's a virtuous cycle there. The fourth source of competitive advantage or moat would be a cost advantage, and that's fairly straightforward. That's when a company can deliver goods or services at a lower cost or have some sort of ability to charge a little bit more for something, inputs that are cheaper for them. A good example of a company with a cost advantage source of moat would be someone like UPS or Walmart. And the fifth source of competitive advantage is efficient scale. And this is the concept that a geographical location or a group of consumers can only be serviced by one or a few amount of companies. A good example of efficient scale might be airports or NASCAR racetracks. You're not going to see certain companies there's not going to be very much incentive for other companies to enter a particular market if it's already being well served by one or a small number of companies.
So some of these wide moat advantages that you just discussed, they seem like they might be a little subjective, like the brands, for example. So how's the strategy taken into account this more subjective nature of some of these things?
Certainly. So that's something that we've been talking about quite a bit with investors and clients to educate the marketplace on how Morningstar does assess a company's economic moat or their competitive advantage. And I think it's easiest to describe it as a combination of qualitative and quantitative processes. Morningstar equity analysts are regularly assessing each of their companies that they're responsible for oversight and coverage on. They are not only looking at profitability metrics, so in essence, the Morningstar analysts are looking at return on invested capital exceeding their weighted average cost of capital and other inputs to measure profitability of a company, but they're also identifying some of these more qualitative features, such as the 5 sources of moats that they can assign to a particular company and have the confidence to assign such a long-term, forward-looking wide moat rating to that company.
And I see that the wide moat focus index, it also takes into account the price to fair value ratios, and it tries to focus on companies that have the lowest current ratio in that regard. Why is this stipulation included over, any other market ratio that's out there?
This has been a very important metric for Morningstar in their equity research process, and the combination of wide moat ratings and this valuation component of price to fair value has been a very successful investment strategy, and that's kind of proven itself out in the history of the index, which dates back to when the index was created in 2007 and back-tested even further to 2002. And what Morningstar does is, in addition to the economic moat ratings and the analysis on competitive advantages that they produce for each and every company that they cover, they also assign a fair value estimate for each of those companies. And they use a discounted cash flow model to assign essentially what is a per-share intrinsic value of a company. And what the index team at Morningstar does is they take both of these outputs, the Morningstar economic moat rating as well as their fair value assessment, and they'll assemble an index that contains wide moat rated U.S. companies that are attractively priced based on this fair value estimate. So they're looking at current market prices for these wide moat stocks and determining which of those are the cheapest at the index review period based on their price to their fair value ratio, and assembling an index of, in theory, or at least according to Morningstar's research process, undervalued stocks.
Okay. And, we've obviously talked about wide moat companies, but maybe you can give us an example of some companies that don't have any moat at all. Is there a certain sector or something that might be a little more prone to no moat companies?
Yeah, that's a great point. I think historically, based on Morningstar's coverage universe, it's easier to put some of these wide moat ratings in perspective in terms of percentages. So of the roughly 1,500 to 1,600 stocks that Morningstar has covered over time, globally, only about 10% of those companies receive a wide moat designation. So it's a very selective moat rating for wide moat companies. And they will admit that they generally tend to cover more moaty companies, so that number is probably a little more skewed than the broad marketplace, where wide moat ratings would be a little bit more scarce. But there are also narrow moat rated companies, and these are those companies that do have competitive advantages, but Morningstar believes that there's some uncertainty in their business model or the markets in which they participate, that they can't have that full 20-plus year conviction associated with the competitive advantage, and they believe that that company can maintain their competitive advantage for at least 10 years. And then there are those companies with no moats, and these are companies that either do not have a competitive advantage whatsoever, or if they do, it may be fleeting and there may be no certainty for longevity in terms of that competitive advantage. One area that we see fewer competitive advantages or fewer moat ratings tends to be in the utility space and the telecom space, based on some lack of competition and regulation in those industries. Those particular sectors tend to have less common moat ratings. But then on the other side, consumer discretionary type companies and various other sectors do tend to have a wide range of Moat-rated companies.
Yeah, looking at the holdings for Moat, I see that there's a little bit of a tilt towards these consumer and healthcare sector. Do you think it's fair to say maybe the whole idea of patents and brands are a little more durable than some of the other advantages out there, some of the other moats that might be, taking place?
Yeah, there's a lot to be said about particularly healthcare companies, pharmaceuticals, and patents and other intellectual property. Morningstar does put a lot of weight towards some of those particular advantages that companies may have against competition. So certainly I think brands and others are very important. Whether or not they're more important than other particular sources of moats, I probably couldn't say. But I will say, based on the current makeup of the index, there are certain sectors that are not included, but a lot of that has to do with that very dynamic valuation component. So the fact that there are a fairly higher representation on the healthcare side at certain points in time along the cycle is oftentimes more a representation of the valuation and the relative undervaluation of particular sectors at the review period.
Yeah, that's a good point. Some of the sector biases might just be a reflection of what the best valued segments are right now. So where do you guys think this fits into investors' portfolio? Do you view it as more of a complement to other products out there, or do you see it as more of a broader market play?
I guess I could break that down in two ways. So we believe very much that this particular strategy is a long-term core holding strategy. So long-term is very important. We like to look at different metrics in asset allocation models and just general performance statistics. And one that we do look at with this strategy very often is batting average, which is a measure that not everyone may look at or may be very familiar with, but it's a very simple concept. It's really just measuring how successful a strategy is versus a benchmark over time. So how often does a particular strategy outperform a particular benchmark? And in this case, we compare Moat to the S&P 500 as a broad U.S. equity index benchmark. And when you look at the live index history since 2007, we go back to March of 2007, for holding periods of 1 month, the index, the Moat's index, the Wide Moat Focus Index, outperforms the S&P 500 about half of the time for 1 month rolling periods in that time period. So it's not exactly a short-term, quick access vehicle, but if you extend out the holding periods and you start to look at 1 year rolling periods, 3 year and 5 year, you start to see outperformance or a batting average in excess of 80 and 90% for those long-term holding periods. So long-term is really the way we look at it, and then our clients and investors that we speak with are using Moat in different ways. Some like to use Moat as an alpha tilt to their core equity exposure, where they're getting more concentrated exposure, in particular, call them active bets through Moat. But many others do use Moat as a core holding. It's a very diversified portfolio in the sense that it does hold currently 43 stocks, so you're getting fairly diversified exposure, but it is more concentrated than a broad-based 500, 1,000 stock portfolio. So the investors have to weigh the risk and return profile, but we do believe it very much can fit as the core long-term U.S. equity allocation in a portfolio.
Sure, and I also wanted to ask you about your international version of this product, the symbol MOTI. Do you guys encounter any sort of unique challenges to using this Moat strategy in the international space?
Yeah, so I'm glad you brought that up. Morningstar, a little over a year ago, expanded their index exposure internationally. So now they offer two indices, not only Moat's index, which is a U.S.-focused index, but now their global ex-U.S. Moat Focus Index, to offer exposure to Moat-rated companies outside of America. And, each market has very different dynamics, which can impact the Moat ratings of the particular companies within those different regions. But with MOTI, M-O-T-I, and the underlying index that it tracks, you're gaining exposure to the full universe of Morningstar's equity research. Not only do they cover U.S. stocks, they cover just as many international stocks, and that was one area of the market that investors really just didn't have access to through an investable product, and now MOTI allows that.
Okay, great. Brandon, I think this was a really solid look at Wide Moat companies and the VanEck funds targeting the space. So Thanks very much for joining us today.
Yeah, thank you very much, Eric. Appreciate it.
All right, everyone, that was Brandon Rakszawski, product manager at VanEck. The ETFs that he discussed trade under the ticker symbols of MOAT and MOTI. You can check out more info on either one at VanEck.com. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. Until next time, for Zacks.com, I'm Eric Dutram.